All right. How's it going, everybody? This is Stable Stories. This is a recurring space as we do here on X to talk about the world of stablecoins, which is growing at an exponential rate. We've done, I think, like 7 or 8 of these sessions, um, partially get into the weeds on stablecoins, but then also, really want to use this as a mechanism to educate people on the space, how to get involved. And I'm kind of the token dumb guy who really didn't know much 6 months ago about the space. So I get to ask all the naive questions that potentially can be helpful when answered for others like me. So we usually start off these sessions with a bit of news, kind of cover off on some of the top stories in the industry, and then kind of dive into a specific topic, which today is going to be liquidity provisioning. But before we jump into it, big thanks to Stable and their team. I think they're building a great product. When I first learned about it, I was kind of shocked at sort of the lack of the service they were providing. So excited for them to be ramping up, and we can hear a bit more about them, what they're working on later. We also have a special guest, Russ, from Liquidity.Land, and he just dropped down. So let me invite you back up to speak. But in the meantime, Jason, we don't always get to hear from you on these spaces as a speaker. So maybe it's worth you doing a re-intro for anyone who doesn't know you, and then would love to jump into some news.
Absolutely. Thanks for hosting the show. It's great to be here again on the show. For a lot of people that don't know me, I work more on the operational side of Stable. So doing the boring business stuff, I'm also the quote unquote token dumb guy on the team. So I understand the space a little bit and kind of who the players are and some of the bigger trends and the technology behind it. But as far as this show goes, trust me, you don't want to. You want to do your own research. This is not financial advice. I'm not the trading quant on the team for sure. I'm really just a champion of stablecoins in general and the economic freedom that this is just really enabling on a global scale, and how we can really use these types of technologies to unlock potentially trillions of dollars of value as sort of this new financial system emerges over time. So you'll see me like always championing Stable in the spaces. And if anybody is an issuer or knows of an issuer of stable coins, we're really opening up our platform to more and more assets as they become, it's democratized in order to create them, I would say. So the barrier to entry is getting lower, and people's ability to participate in financial instruments like this and on-chain forex and all this stuff is just now starting to emerge. So it's very exciting. I'm excited to be here, and also excited for the road ahead.
Yeah, absolutely. And before we get to Seb, who I saw who joined us as well, Russ, saw that you joined us again. Would love to hear a bit of your background, and give people a chance to kind of hear about what you're working on right now.
Sure. Hey, thank you for inviting me. So, yeah, basically Russ, founder of Liquidity.Land. I've been in space for last 8 years, building different products. Also, was running a venture syndicate called Friends, where we deployed in more than 20 companies for the last 2 years. And basically, a year ago, we started building Liquidity.Land, which basically solve liquidity provisioning issues for protocols. We help protocols bring TVLs and save funds for customer acquisition costs for protocols, and users get a boosted and increased rewards for providing liquidity directly to protocols.
Awesome, amazing. Thank you so much for being with us today. Before I throw it over to Jason again, Seb, want to say a quick hello?
Hello.
I took that very literally. I like it. Good times. Seb also representing the Stable team. So yeah, I mean, pretty big news week. Maybe we start off with stablecoin adoption. Some news out of JPMorgan and the JPM coin on Base. Particularly funny if you kind of rewind 5 years and, hear about how JPMorgan leadership is talking about crypto in general, and fast forward to JPM coin. But yeah, Jason, you want to
Yeah,
jump in on that one? Oh, sorry, go ahead.
they really kind of ping pong around with their opinions on stablecoin. Jamie Dimon and JPMorgan in particular. But yeah, I think this was a long time coming, and it's really the first like major deposit token, which means, I guess, unlike a stablecoin where the reserves are made up of cash and treasuries, this is actually a claim on JPMorgan specific bank deposits. I believe initially it's open for like institutional users, but they do hope to like decentralize and open up to everyone eventually. The other big kind of USD stablecoin announcement was Western Union, which most of you would have heard of. But that really just shows how these kind of remittance and international transfer companies, Western Union's one, but also like TransferWise, how they are almost too late, but planning out their stablecoin strategy and how stablecoins can reduce their fees and settlement delays for around the world.
Yeah, that was going to be my question. Maybe Jason, you want to jump in on this, but yeah, is it too late? Like, are they already being outshined by emerging players and just trying to force fit kind of a Web 2 archaic model into Web 3 because they have to?
Well, I think in order to remain like competitive, they're seeing their margins slowly get eroded, or the potential for their margins to get eroded. So you see, like now, the industry in general and the old guard in general is just scrambling to throw money at the problem, whether that's via like acquisitions or which is happening in a majority of the cases. They're buying these underlying companies and for their infrastructure and sort of rapid go-to-market strategy. But I don't think, because they have such a giant moat of cash built up already, that these players are quote unquote down and out. In fact, they're just basically just, waiting for the right company to build a solution that's turnkey for them. And then they can just deploy it. And you see even the largest of the largest players, which is, I think, the ongoing narrative is like, okay, well, JPMorgan, Jamie Dimon is famous for saying that Bitcoin is rat poison, right? And so now he's basically feeding rat poison to his entire client base. So I don't know what that says about Jamie Dimon's commitment to his customer base or what have you, or just the strength of the technology itself, just being unstoppable code. So everybody's going to be in this. And the biggest tell is everybody, for as long as I can remember, has had problems with the Swift network as it's grown bigger and bigger, and this centralized pay-to-play entity over time. And now even Swift is saying like, yes, we're going to add a blockchain ledger, right? So everybody's going to jump in. It's not too late. In fact, it's just the very beginning. It's the early wave. We haven't seen a lot of these newer types of instruments, such as sort of the JPMorgan stablecoin, but quote unquote like deposit tokens, and some of these newer instruments that are based on all kinds of different debt models really launch yet. So I think we're in the early days. It's still plenty of time to get involved. And that's kind of why we're trying to build that at the frontier. We see the local stablecoins only becoming more and more prolific over time as each country realizes that, wow, we should really have a stablecoin strategy, or else somebody is actually going to create, one for us and benefit from the rewards from doing that, as in the case of some of our coins that you even see on Stable. So this is really exciting. This is the forefront of the revolution. Nobody is basically going to get left out if they have too big of a purse because of shareholder pressure. So JPMorgan is just the first of many to fall. We see this with MetaMask, even Amazon talking about their own stablecoin. So we see like really a stablecoin explosion happen, or at least I see a stablecoin explosion happening in 2026. Even more so than we see now.
Sorry, Jason. I would agree that it's definitely not too late. I think these existing big companies have the advantage of like having a use case and users and demand for the technology that they can like use immediately. For an issuer that's just creating a stable coin, they have to like go out and find demand and find use cases. But for Stripe, Visa, Western Union, they have the benefit of being their own like first and biggest user, which I guess was something that like Amazon applied in their like delivery business, being the first and biggest user. So no, I don't think they're too late. And yeah, it is exciting to see, especially for the like global remittance and international transfer use case, because I could see Western Union bringing in local stable coins into their like settlement network. On that topic, there are just a couple of local stablecoin news that came out recently from Japan. The first yen stablecoin to launch under Japan's new stablecoin regulations was launched. Well, I guess relaunched under the new regulation, JPYC, and that's competing with the NY regulated GYEN, and also in Nigeria, the cNGN stablecoin, which is again the first SEC regulated local stablecoin, not the US SEC, that has seen like huge growth in its first 6 months, about 15 million in transfer volume.
Yep, absolutely. And I believe out of Nigeria as well. If you want to talk a little bit about what we're seeing there as well.
Yeah, I mean, the Africa region as a whole was a very early adopter of particularly USD stablecoins. So they do have a lot of like Web3 startups that are doing payments and like remittance across different African nations already set up, and they are slowly starting to adopt local stablecoins as opposed to USD stablecoins, which it's definitely an area that we're Stabull are focusing on as more local stablecoins come to market from Africa, and I think it's like, if not the biggest kind of area of growth for local stablecoins, particularly in that like cross-border transfer. I think I've said it before, but a lot of cross-border transfers of money within the African region have to first go through the US dollar, which kind of leaks a lot of money out of the system. And so with local stablecoins, you can have pairs between like the Nigerian Naira stablecoin and a Kenya shilling stablecoin, and you don't have to first go through a USD stablecoin.
And just to kind of add on to that, I would really suggest to anybody that is interested in that topic of how local stablecoins are shaping Africa, what the situation on the ground is there. The previous episode that we did with Simon, who's a part of a project with the African Rand stablecoin, really was able to shine a light of some of the problems that the local stablecoins are solving, and really why it's just really a matter of time as to how much penetration that the stablecoins are going to get over there and how rapidly they're being adopted. So that was our previous episode, just to kind of give that like a shameless plug, really, because that was so much info that was dumped on, and we will probably have Simon back in a few months' time just to really bring us up to speed, because so much is really happening behind the scenes to transform the financial infrastructure over there using crypto rails and crypto technologies. And Web3 is absolutely explosive over there. And it's important to, I guess, bring to the attention that even Jack Dorsey, who is the famous founder of Twitter, really has focused a lot of his efforts around Bitcoin and Bitcoin adoption in the Africa diaspora. So you're seeing his efforts really start to mature now, and you see a lot more crypto being taken up there.
All right, and maybe just to kind of speed run through some of the other stories. I think the hack heard around the world was the balancer hack for over 100 million. Some of that was recovered. Certainly a lot of people were disappointed to see that, given kind of the OG status, of the platform. And but whenever these things happen, it does strengthen the network. It helps people understand what are the exploits, what are the things that need to be implemented to mitigate it from happening in the future. And thankfully, it was only, it's crazy to say this, but thankfully it was only 117 million, and not more, because obviously a lot more money goes through there. On the sort of stablecoin side, there has been a drawdown in synthetic USD stablecoins recently. I think the market's going through some weird stuff right now, so a little bit of a conservative or kind of downward action because of some of these things that are taking place. On the flip side, I think on a more positive note, Uniswap had a major announcement, turning on, Uniswap token burns, and I think, with a slightly easier regulatory environment right now, especially in the U.S., able to do quite a bit more with their platform. So very exciting to see that. I don't know if you guys want to comment specifically on any of those news items.
Yeah, I mean, there were obviously a couple of big stories in DeFi over the past week or so. The drawdowns and the number of synthetic USD stablecoins caused a decent amount of kind of effects throughout DeFi. It was, I think, started by a stablecoin XUSD by Streams Finance, lost 93 million, and that kind of caused some contagion across similar synthetic USD stablecoins. The thing I wanted to point out about these synthetic USD stablecoins is they almost kind of act as a fund. Like, maybe they are obviously on smart contracts, and there's some semblance of decentralization or non-custody, but really you are handing over your capital either in USDC or whatever you're depositing into a fund manager or a risk curator, they're often called, and they use that money in what they call like a delta neutral strategy, whether that be like looping through farms or some kind of basis trade. So I just wanted to point out that there is a big difference between these synthetic USD stablecoins and the kind of more known fiat-backed stablecoins like USDC and the local stablecoins that we talk about with Stabull. That when there are drawdowns, they can often have very big effects on these synthetic USD stablecoins because it's less transparent what the reserves actually are.
Yeah, I actually agree with you about the X basically stream. But in general, like all these stablecoins thing, like they tried to pre-pack different DeFi baskets into new narrative, the stablecoin, but most of this, like I believe, like right now there is around like 200 stable coins on the market somehow trying to survive, but in reality most of them, I think, launching a stable coin just for hype, and Stream was one of the example. The funds was managed via fully custodian ways, so the Revolt basically transferred the funds to asset manager, and asset manager basically deployed funds manually in different contracts, and moreover, like they took an incredible risk, like Seb mentioned. At least as I know, like there was minimum triple looping for all these assets, and I think it was a question just when it's gonna blow up. But the most sad stories, I think, like in there's guys who are providing liquidity on Morpho or on Euler, on Silo, or basically different money markets versus stream stablecoins. We were fully locked because the Oracle was hard coded to 1-to-1. So the guys basically who were thinking this, they can like get the money back anyway, almost
Exactly.
all the deposits. So I think like even without getting like incredible rewards, because I think like the API was somewhere around like 8 to 10%.
Yeah, I think it points to kind of almost a broken mechanic in the yield bearing stablecoin market. Like a lot of these new stablecoins or new synthetic yield bearing stablecoins that failed, it's kind of a race to have the best APR. And I guess they're all benchmarking against the biggest one, USDE from Athena. So they're trying to get the highest TVL, and that means pumping up the APR. And that unfortunately often means moving into riskier and riskier yield strategies. The problem is a user sees like 18% APR for a particular yield bearing stablecoin, but there's no transparency on where that APR is coming from, and in particular where their like capital is being used. So I think that's like brought up a topic that will hopefully be improved. Specific to this kind of subsector of DeFi is like how they can make their credit risk and counterparty risk more transparent. Because for a lot of these cases, a user would be depositing into a vault or a stable coin, and they'd see that the strategy was in like blue chip lending or blue chip stable coins. But then 2 months later, while they still have a position open, that the risk curator or fund manager changes the strategy to a riskier one, and the user doesn't really have any knowledge of that. So I think that's kind of the crux of the issue there.
Yeah, just to kind of translate that to an
Yeah,
average
thank you.
consumer like might see, when you go to a bank, they might promise you 3%, 5% yield, and that's guaranteed, right? Like that's there is absolutely no risk there, as long as basically the government of that country is in a good place. With stable coins, as people look to move their money and hold their money, their fiat currency in stables, you're going to see a lot of competing interest rates that are being offered, right? 5, 10, 20, 5,000%. And so there is risk there. And as Seb is saying, like, if you don't really understand where that yield is coming from, there's a big challenge there, because the higher the yield being offered, more likely or than not, the investments that those stable coins or those reserves are being put into are riskier. So if you're seeing 5 to 10% interest on stable coins, on your platform of choice, probably safe bet. If it starts to go much higher than that, you have to really just do your research. Yeah, go ahead.
I was just going to say, yeah, that is a good point on like DeFi APRs in general. They're predominantly going to be like a point in time estimate. So if more TVL comes in, if the reward token changes, a number of variables change, that APR could be different from day to day, which is different to generally when you deposit money into a bank and you've got a fixed APR for a certain amount of time.
Yep, exactly. Cool. Well, just to round out, other stories in the news that people might have missed. Visa is pushing forward with the pilot program in the stablecoin arena. Always good to see that. Again, sort of like better late than never, but it's finally happening. And Cash App is embracing stablecoins as well. Jack Dorsey, famously at BTC Maxi, thinks you should be buying everything in Bitcoin and screw stablecoins, but nonetheless, the dollar is, and other stable coins are used frequently. So good to see Cash App as a business, embracing that as well. Yeah, I mean, before we jump into sort of our key discussion area, anything else you guys want to touch on?
I think you've covered it, but this is just a fraction of really what's going on with the stablecoin environment in general. Really, we try and bundle the news, but there's so much happening that it's kind of hard to understand like how fast the space is evolving, which is why we have these spaces, and hopefully we'll have more people from different sectors that are coming in to talk about specific things. But even the topic today about like liquidity provisioning and understanding that there's a big difference in the pools that you participate in and how to participate in them, because there's a lot of news happening, but it's really hard to understand with all this going on, how does one actually get involved with the space. So we kind of have to switch between like always reporting on the news and also being pragmatic in our discussions in helping new people sort of understand, well, what is happening, but why does it matter to me, and how can I actually benefit from it? So just because there's a lot happening in the space doesn't necessarily mean that it's so complicated that the average person can't really understand at a base level what the use of these local stable coins and what stable coins are and how to use them.
Yeah, appreciate that. And yeah, again, like this is part of the reason I really wanted to partner up with these guys. Is there's a lot to learn, but I think it's all very digestible, and eventually will become sort of common knowledge that the same way you might tune into programs like CNBC or other financial programs, and it's just something that I think is important for people to learn more about. So with that in mind, great news coverage, great volume of news that we're seeing in the space. But let's talk about the key topic today, which is liquidity provisioning. So Russ, going to give you the great honor of explaining what is liquidity provisioning for those who have never heard of it.
Thank you. Yeah, the liquidity provisioning is basically a similar process of interacting with smart contracts in different protocols, where you supply your stable coins or different types of assets to make it work. And usually DeFi basically have different primitives like money markets, basically lending protocols like Aave or Uniswap or similar. And yeah, you basically supply it to the protocol, and there's thousands of different parameters, or you have to know, but like I just be a little bit more specific about something particular.
Yeah, I mean, Seb, Jason, do we want to dive in kind of a little bit, to any particular area of the space?
Yeah, speaking of primitives, I think the first kind of lesson for maybe new to DeFi people wanting to LP is to understand like the different kind of subcategories of liquidity provisioning within DeFi, and in particular the like risk you're exposed to. So I think probably the main one when people think of liquidity provisioning, or maybe the first, is providing liquidity to an AMM or a DEX like Uniswap or Stabull. So that's when you're providing usually providing two sides of a pool, and you are kind of at that stage, as the name entails, automated market maker. You are kind of a market maker in that respect. You're providing liquidity so people can swap between them, and your yield is generated from the spread or the trading fee, just as a market maker in a traditional order book would. The other kind of subcategories are obviously lending markets like Aave and Morpho. You can provide liquidity there, or you're basically lending out your stable coins so others can borrow them, and you earn a yield on that. That's mostly exposed to a credit risk, basically the risk that the collateral that the borrower is providing loses value. There's also, I guess, what we've seen, or what we spoke about just recently, was LPing in kind of vault and or curated vaults and yield-bearing stablecoin, where the risk curator or fund manager is deploying that capital into some kind of strategy, whether that's transparent, the strategy, or not. It's usually some kind of counterparty risk. They are deploying it into lending markets or AMMs as well. And for all of those three categories, there's, of course, as we saw with the balancer hack, there's a smart contract risk as well. And they each of them have different APRs, but I think it's important for users when it's quite often you see somewhere to deposit a token in an APR, but you quite often skip over like where it's actually being used and what you're exposed to.
Yeah, Russ, do you want to potentially talk through like the different types of APRs, so just people can understand if they're seeing, if they're seeing a percentage, like, and they see concentrated liquidity, point in time, like what are the different types of sort of fuel behind an APR?
Yeah. I would say the main difference between the percentage of rewards being generated is how new is the protocol, basically, because most of the incentives comes from the native tokens. Let's say if you just apply liquidity to already sophisticated protocols like Aave or Spark, you're most likely going to be generating like 3, 5, 6% annually. But at the same time, let's say if you just go to a newer protocol, and there might be also a lending market like Aave, but maybe some with new modern modifications or new features. So it's still like most likely it's still going to be generated like 6, but the user's expecting airdrop, which might be like 10-20% IPI and higher. So and I think like it's main incentive like to drive why people like put their funds in the new protocols. But maybe like I can give a small advice for new users. I think it's better to start like with more blue chip protocols, maybe Spark, like Morpho, Aave, and then slowly like learn about when you already know some primitives and fundamentals. Basically, go drive and explore different categories. At Liquidity.Land, what we're basically doing, we also make due diligence for these protocols and we negotiate a higher yield for providing liquidity to them. So basically supplying liquidity to the same protocols, you basically generated up to 50% higher rewards doing through Liquidity.Land, and you still participated via non-custodial way when you just doesn't have any risk to any custodian risk or smart contract risk on our side because you still deploy liquidity directly. So I guess there is what we are trying to solve in the DeFi space, but yeah, I believe like there is many other niches which exist.
Yeah, and just to add to that, because I think it is an important question when you see like an APR, and yeah, it's not always clear where it's coming from. I think the like kind of main categories that most protocols kind of show is some kind of base APR, which is like the more sustainable side. For an AMM, that's usually trading fees or the spread. So when people swap across the pool where you've provided liquidity, the pool is capturing a spread. It's often called a fee, and it's keeping that for the LPs. So when they withdraw, they get a bigger portion of the assets that they deposited. In lending markets, that's often the borrow rate. Obviously, someone's paying some kind of borrow rate to borrow assets, and that gets that's there for the lenders to capture. And then the other side of APR, apart from the base APR, is obviously the incentive APR, or the boost, it's quite often called. But that's when protocols are trying to incentivize liquidity, so they're paying some kind of incentive to try and attract more LPs. And depending on the life cycle of the project, they'll have different, I guess, percentages of how much of the total APR is base versus the incentive APR. The other thing you mentioned, Board, the concentrated liquidity, that can also get a bit conflated and perhaps is less transparent, is you often see huge APRs on DEXs like ERGO and Uniswap, the concentrated liquidity AMMs. That's often the APR for the lowest range. Obviously, on those AMMs, you can kind of set your liquidity between a certain range, like price range. If the token's trading at $1.40, you can set your liquidity between $1.30 and $1.50. And that kind of sticker APR, or the APR that the pool is showing, is only if you're in a very tight band around there. So LPs that are deploying capital to the full range are going to get a lot less APR.
Yeah, I've been learning a lot more about this myself. Just trial and error, practicing full range, concentrated liquidity, and kind of finding the right balance, and also not having to be glued to my computer 24 hours a day to to lose money. And
Well, yeah,
grokking.
the thing with concentrated liquidity is they do see a lot of TVL, and they've been very successful. This is Uniswap v3 introduced the concept of concentrated liquidity, and Aerodrome as well. But it does require a lot of management as an LP. So if you do want that sticker APR and you're deploying liquidity in a tight range, you're probably going to have to, depending on the volatility asset, you're probably going to have to withdraw and redeposit that position in a different range an hour later or a day later. So it's just a lot more hands-on and time intensive. And that generally means that in these high APR pools with a lot of TVL, the APR is a lot more skewed towards professional LPs rather than retail LPs.
Yeah, on that note, I think the concept of TVL is also something that maybe is a bit foreign to people. Russ, can you talk a little bit about total value locked? Why is that important? How you guys are working on things at Liquidity.Land to stress the importance of that, and I guess make it easier for people to feel comfortable moving their funds into various DeFi or stablecoin kind of products.
Yeah, so the basically TVL is a total value locked. Usually is a dollar equivalent of the sum of being locked on the smart contracts or protocol, or being managed by protocol. Why is it important? Because usually it's just increase trust from retail investors as well as institutionals. The protocol basically is more funds the protocol has. Supposed to be that it have certain economic stake, and many different hackers might try to hack it or try to abuse or breach the protocol. But basically, the more funds it has, it basically means it has more economic security in a way. So this protocol is supposed to be more safer than new ones. And usually retail investors are being really accurate with new protocols. So sometimes usually first these protocols go to institutionals or liquid funds to supply certain liquidity, then to basically get confidence from retail investors.
Yeah, that makes sense. I mean, TVL basically can inform someone of how active is the network. You know, do people feel confidence in it? You know, I lock my money in a protocol or a smart contract because I see many other people are doing it as well. It implies that it is probably safer. If there's $500, locked somewhere, maybe not. So yeah, appreciate that background. Russ, in terms of Liquidity.Land, who would you say is kind of your primary customer? I mean, could you see kind of everyday consumers or even like AI being your customers, or how are you guys thinking about that for the short term and the long term?
For the short term, I think basically for AI, like there are a few attempts, like maybe even like relatively successful. But I think institutionals and professional DeFi users still a little bit aware of these AI agents, because you still have to understand the underlying risk, supply and liquidity in the protocols, and how these agents usually operate. They rotate liquidity between many of them, trying like to find most lucrative opportunity for liquidity provisioning, but at the same time, it basically means it's if any of those protocols basically got hacked, and will or gonna offer like higher API, so the CI agents most likely gonna supply the liquidity there, not knowing that it might be compromised or. And if you talk about our customers right now, it's mostly pro DeFi users and family offices in Wales, and even institutionals, because what we're trying to do is bring transparency to DeFi markets, and instead of just giving users points, but most of our protocols offers an increased API in the native tokens, so liquidity providers might assess not just the risk but also calculate the future rewards. And yeah, main demand basically comes from institutionals, because our main goal is to basically bring more liquidity, but at the same time we're actually growing our retail vertical, our retail app. So basically anyone starts from like $20 can get an institutional grade yield and deploy in any of our portfolio protocols.
Yeah,
Yep.
I just wanted to chime in here. It is the state now where a lot of these tools and a lot of these services like Liquidity.Land and even providing liquidity on Stabull may seem a little bit daunting at first, but it is something that is accessible to people if they just do a little bit of research and a little bit of digging. And one of the reasons that it is so powerful is because that these instruments were previously completely inaccessible to your average everyday person. But now through these protocols, they are becoming slowly unlocked. And so there's more and more opportunities. However, that does require you to kind of go down this rabbit hole and understand how to do these things. There is definitely a learning curve. And because you are, spending your own money, you're investing into the crypto, this could be just like if you were trading stocks or FX or Forex or doing anything in financial markets, there's always a real risk of loss, against that gain. So I encourage everybody to kind of, look at all the resources that are out there, kind of follow on some of these channels. And even if some of these concepts seem a little bit confusing at first, they just kind of like dig a little bit deeper, read a little bit more, follow some people on, on Twitter and YouTube, and really take advantage of some of the educational materials that are out there. And, it's up to us as, Stabull platform and, other companies like Liquidity.Land to slowly make this a little bit more easy to understand. But it is going to be a process that takes time.
And Russ, really quick, just kind of back to you, for those people who are newer to the space, just about maybe your personal journey and kind of learning about DeFi, going back to the beginning. But any advice for people who want to just enter the space, in the short term, how did you learn about it, right? Is there anything you can recommend to others who want to get started today?
Yeah. I think like my journey like started in 2018. So DeFi even wasn't existing yet, because I think like most primitives comes in like 2020, as I remember. But yeah, my basic advice is just start with the more blue chip protocols. So, and not just trying to pursue the yield or some sort of optimization, but basically try some primitives. And when you're already going to be confident with these tools, I mean, just slightly to expand to more riskier or to more sophisticated strategies. And yeah, and basically slowly extend your knowledge. But to start it, like with providing liquidity is relatively easier. For some of them, like it just takes like 30 minutes maybe to start, like, or to learn how to supply liquidity in some basic protocols like Kava or similar things. Yeah, so, and yeah, the earlier you start, like, the more confident you'll become over the time. So yeah, there is my advice.
Very good. Seb, maybe you want to jump on this one, but just, talking about kind of use cases for liquidity pools, I think, you know, before people feel really inclined to learn more and kind of, jump into the space, it's important to understand, well, what are they for? So, would love to just kind of, get your perspective on, why liquidity pools are important, at a sort of a, high level.
Yeah. I mean, obviously liquidity pools have their use cases on their own, obviously swapping and then providing liquidity and earning a yield, but they're also, as Russ said, like a major, well, almost the biggest primitive within DeFi. A lot of use cases and projects get built on top of them. And I think that's most truly seen in, like, I was looking at Polygon gas usage and like total transactions across different protocols on Polygon and Base. And even though you like hear about Polymarket on Polygon the most, it's really not contributing as many transactions as, say, Uniswap, which is very like composable and gets used in a lot of different use cases, whether that be like aggregators trading across it or lending markets liquidating collateral. So that is kind of the bigger use case of AMM pools, as they are like a primitive that other products are built on top of, and they're definitely like a plumbing that's important to DeFi. So yeah, we definitely hope, and we're working on with some partners, some, I guess, higher level products like vaults that use the pool as like an APR source or use it for swapping against, particularly in the like local stablecoin and FX on chain theme. One example is like from traditional markets is the carry trade or basis trade with Japanese yen. That obviously in a DeFi version of that would involve swapping between well, first borrowing the Japanese yen, but then swapping it to a USD stablecoin, and then somehow getting exposure to an FX hedge, which in DeFi can look like an AMM position. So you're hedged between USD and JPY. Just giving some examples of like ways that AMM pools are used as a primitive.
Yeah, super helpful. Appreciate that. Well, awesome. Appreciate you guys, jumping on and doing these spaces. For those who listen live, and of course who are going to be listening to it in the future, we'll be clipping some of the key sections here for everyone's enjoyment. But Russ, before we wrap up, do you want to do kind of a quick sort of call to action? How can people get involved, learn more about what you're working on? Oh, Russ, you there? Oh,
sorry, I got muted. Yeah, I got muted. Sorry.
No worries.
Yeah, so basically, like, it's very easy to start. Just go to Liquidity.Land, and we'd rather recommend like start with graded offerings, but you still can explore different protocols, or even can get boosted rewards for protocols you already provide liquidity in. For example, we work like with EtherFi, Solare, Maple, and many others blue chip protocols already, which already established on the market. But yeah, it's fully non-custodial. Just come and try.
Very good. Seb, do you want to do a quick overview of Stabull, kind of where things are at? Any latest updates or news?
Yep. First of all, we've got some new listings happening in the next week for AUD, Australian dollar stablecoins, as well as some additional gold token RWAs being listed on Stabull. The other thing, we do have a Liquidity.Land campaign running at the moment where you can get like a 10% APR boost on any liquidity added to the Stabull platform using the Liquidity.Land referral link. So that's at app.liquidity.land, and you just search Stabull. But yeah, a lot happening. We're working on our aggregator integrations at the moment for Paraswap, Valora, and 1inch. So that's a big thing for us to drive volume and kind of solidify the use case of Oracle-driven AMM. And yeah, I'm not sure if you had anything else, Jason, you wanted to shout out.
Yeah, we've just recently also working over our liquidity mining program to make that really a compelling offering. So we have some recent announcements around that, and basically just adding a lot more assets. Like I said, this is 2026 is really going to be a stablecoin explosion, and so we're really prepping for that, especially on our RWA side. We know we have a lot of things that are just right around the corner, but we can't just announce yet. But look for end of the year, lots of things happening with Stabull, and we will continue to have these spaces. And we look forward to the next Stabull stories here in a few weeks.
Yeah, appreciate that. Russ, thank you so much. Seb and Jason, thank you for co-hosting as well. Jason, you have to drop some alpha very soon on one of these spaces with your teaser right there. But yeah, looking forward to those, and appreciate everyone who's been tuning in to these sessions, and many more to come. Jason, looks like you unmuted if you want to chime in there.
Yeah, I think next week look for those pools, because there's a lot of trading action, and it is shiny, and more things are coming onto the Stabull platform as we speak. So I wish I could announce a little bit more, but you're just going to have to stay tuned for the next show.
All right, there you go. Today's a good day to turn off your computer and not look at the market, and just be ready for next week when Jason has more to share. All right, thank you so much, everybody. Have a wonderful rest of your week and weekend, and we'll be back soon. Thank you. Bye.